Now we're going to look at those formulas with the snow glide example. So we have a contribution margin of $54 from each board. We have total fixed costs of $37,800. So given that information, we know that Snow Glide must sell 700 boards each month to break even. We can then look at how many boards must they sell to earn a target operating income. So at the bottom, we're looking for a monthly operating income of $5,400. So we add that to their total fixed costs and divide by their contribution margin of $54 per board. And we're given that they must sell a minimum of 800 units per month in order to meet that target income. Now, the break-even number of units or the CVP number of units when we're doing these, you won't always get clean numbers. CVP analysis does not follow the same rounding rules as normal math. So normally for math, if you have below 0.5 after the decimal, you round down, and above 0.5, you round up. With CVP analysis, if there is any number after the decimal point, you round up, because if you round down, you will have a negative income. And you can't sell a portion of a unit. So if that formula had actually turned out 799.015 units per month, we can't sell 0.015 units. If we calculate at 799, we're not going to meet that target $5,400. So we have to round up to the next full unit. Now, how many sales dollars must we generate? So to find the sales dollars, we use that same information, the fixed costs and the target operating income. Except in this case, instead of dividing by the contribution margin in dollars, we divide by the contribution margin unit percentage. So our total sales volume needs to be $72,000 per month. That is the sales volume that will give us a monthly operating income of $5,400. What is our margin of safety? Well, the margin of safety is the difference between our current sales and the sales at which we need to break even. So what that margin of safety tells us is how far can we drop before we start operating at a loss. So we see here our break-even sales volume in dollars is $63,000 per month. That's the minimum amount that we need to have a zero operating income. Therefore, if we have monthly sales of $73,000, we have a margin of safety for that month of $10,000. The margin of safety can help us have a quick means of estimating any operating income at any projected sales level. So this relationship shows as follows. We have the operating income equals margin of safety times contribution margin ratio. Now we're going to talk about some of the different ways that we can use CVP analysis in a business. It doesn't have to just be used to say what is our break even or what minimum amount of sales might we have to make. So first, we're going to look at the director of advertising. Right now, we're selling approximately 900 snowboards each month. Our director of advertising believes if we increase our advertising $1,500 per month, that we could increase our number of boards. So we're confident, or director of advertising is confident, that the advertisements will result in monthly orders from East Coast distributors for 500 boards. She wants to show the impact of her request of $1,500 a month on the company's operating income. So she's going to look at what is the current operating income based on sales of 900 units. Then we're going to compute an estimated monthly income based on 1,400 units, taking into account the additional advertising cost of $1,500. So we have our current sales of 900 units at $90 per board. Then we have 40% of our costs are variable and giving us a 60% contribution margin. We know our current monthly costs are $37,800. So we have an estimated current monthly operating income of $10,800. Now she wants to know what happens if we increase our monthly fixed cost with her advertising budget and increase our sales by 500 units a month. Using our current contribution margin ratio of 60%, which doesn't change because we're just going to be increasing our fixed costs. So if we look at our new fixed costs, or our new fixed costs of adding the $1,500 a month, we find that we get a target income of $25,500, higher than our present monthly figure of $10,800. Therefore, the director of advertising believes that her request for an additional $1,500 is well justified. If that campaign is as successful as she believes it's going to be, it's going to give us a real boom in our sales. However, the plant manager is pretty concerned about this. He doesn't completely agree with the advertising director's projections. He believes it's going to put a lot of pressure on the plant's production capabilities to have to increase their production by 500 boards a month. In order to cope with the extra manufacturing, he believes that many of his factory workers are going to be required to work overtime hours, which is going to increase the amount of cost, approximately $1.80 per unit. Assuming that he is correct, he wants to know the sales volume in units required to still achieve the advertising director's projected monthly income figure. So we do some CVP analysis with his projected additional costs. He's going to add variable costs, which reduces our amount of contribution margin. So in order to justify the fact that this increase in $1,500 is going to increase our sales by 500 boards a month, he believes that's going to increase the amount of overtime we have to pay employees in order to meet that production. So in order to still meet that amount of operating income, the plant manager projects that we would actually have to sell 1,448 units per month in order to meet the projected income of $36,300. The vice president of sales isn't convinced that even this monthly advertising is going to have that effect of 500 units per month. She does believe that it's going to increase their amount of sales, but she doesn't think it's going to be 500 units per month. So the vice president of sales wants to be a little bit more conservative, but she's also going to take into account that the direct labor costs are probably going to increase with any kind of extra production capacity required of them. So in this example, we're looking at both the increased costs and the reduced contribution margin. So what we're looking at here is if we have fixed costs of $39,300 from the increased $1,500 a month sale, and we're still hoping to make that $36,300. For 1,250 units, we now need to change our contribution margin from $52.50 per unit to $60.48 per unit, which would require us to raise our unit selling price from $90 a unit to $98.28 per unit. So when we're looking at this CVP analysis, we've looked at a lot of different things. How can increasing advertising have an effect on our sales, which then eventually has an effect on our bottom line? But then we also talked about, can we actually increase our capacity without increasing costs? Not very often. So we have to understand how our costs work in relationship to each other and what changes in costs are going to cause changes in other costs. For example, increasing our advertising budget was going to require increased capacity, which would therefore increase the amount of labor costs we had. When we sell